Most people see dense spreadsheets and immediately feel completely lost. It's intimidating, right? But here's the truth. A balance sheet is literally just a photograph of a company. It shows you exactly what a company owns and what it owes on one single day. That's it. Welcome to this explainer for the ViewPoint, where we're going to show you how to confidently read one in under 10 minutes. Here's our roadmap for today. We'll cover 1. The golden rule. 2. Equity and long-term debt. 3. Current liabilities. 4. Fixed and current assets. 5. The working capital cycle. And finally, 6. Ratios and yearly trends. Okay, to make every concept crystal clear as we go through this, we're going to use a fictional supermarket chain called FreshMart Retail Limited. Take a look at the date at the top there, 31st March 2024. Remember, a balance sheet is always prepared on one specific date. It's a snapshot, not a movie. Also, keep in mind that all figures here are presented in Indian rupees in lakhs. So when you see the number 500, that actually means 500 lakhs, or 5 crore rupees. Let's dive right into Section 1, the golden rule, the absolute foundation of accounting. Before we read a single line item, we really need to understand the most critical, unbreakable law that governs every financial statement in the world. And it's this. Assets must always equal liabilities plus equity. Always. There's literally no exception to this. It brilliantly illustrates the whole foundation of accounting. If you look down at the bottom of FreshMart's balance sheet, total equity and liabilities perfectly match total assets at exactly 3,570 lakhs. If these two numbers ever don't match, well, one of two things has happened. Either there's a major accounting error or someone is hiding something. Moving on to Section 2, equity and long-term debt, or where the money came from. Let's start our walk down the right side of the balance sheet to uncover exactly where FreshMart got its funding. First up, we look at the shareholders' funds, which is also known as equity. Put simply, this is the money that belongs to the owners. Share capital, sitting right there at 500 lakhs, is the founders' seed money. It's the initial investment they put in to get the supermarket off the ground in the first place. Then we have reserves and surplus at 1,250 lakhs. Think of this as the fruit the tree has grown. It represents the profits the company has actually kept inside the business over the years, instead of paying it out as dividends. Add those together and you get a total net worth of 1,750 lakhs. This is the chunk that belongs purely to the owners. Now, what about the money they borrowed? Well, that brings us to non-current liabilities. The biggest item sitting here is an 800 lakh long-term bank loan. FreshMart likely borrowed this to fit out new store locations or maybe buy some really expensive refrigeration equipment. The absolutely crucial point here is that word non-current. It safely means this loan doesn't require repayment within the next 12 months. We can breathe easy for now. Section 3. Current liabilities and suppliers. These are the short-term obligations. Moving further down, we hit the immediate financial pressures the company is facing right now. Current liabilities are amounts FreshMart owes and absolutely must pay within the next 12 months. What's really interesting here, though, is this massive 620 lakh figure for trade payables. What is that? Well, it's money FreshMart owes to its suppliers. We're talking companies like ITC, Industry Unilever, or Britannia. These suppliers delivered goods to FreshMart's shelves, but FreshMart hasn't actually paid them yet. And you know what? This is completely normal in retail. It's called trade credit, and it makes up a huge portion of their 975 lakhs in short-term obligations. Next up, Section 4, Fixed and Current Assets. This shows us exactly where the money went. So we know where the money came from. Now let's switch over to the left side of the equation to see how FreshMart spent it all. We start with non-current, or fixed assets, sitting at a hefty 1,800 lakhs. To make this really tangible, just think about every physical item you see when you walk into a supermarket. This 1,800 lakh figure represents every single commercial refrigerator, billing counter, air conditioning system, and delivery truck FreshMart owns. These are the long-term heavy lifters, assets the company is going to use for many years to generate revenue. Next, we have current assets. These are things that will convert to cash within 12 months, and honestly, they're the lifeblood of a retail business. Look at the 480 lakhs in inventories. That's the value of every single packet of biscuits and bag of rice sitting on their shelves right this second. And very importantly, they have a healthy 210 lakhs in cash and cash equivalents. This is pure money in the bank, ready to be deployed. Which brings us to Section 5, the working capital cycle. This is all about running on suppliers' money. We've arrived at the climax of our deconstruction here. This is the real magic of how supermarkets brilliantly manage their cash flow. Let's map out this cycle step by step. First, FreshMart orders products and gets, say, 30 to 45 days of credit from their supplier. The goods go straight on the shelves. Then, customers walk in, buy those goods, and pay instantly via cash or UPI. FreshMart collects that cash immediately. Then, weeks later, they finally pay the supplier. Think about that for a second. They are cleverly collecting cash from customers way before they ever have to pay their suppliers. This means suppliers are effectively financing FreshMart's inventory. It's essentially free money, a totally incredible profit engine, and it is exactly how the biggest retail empires operate. Let's wrap up with Section 6, Ratios in Yearly Trends, where we start analyzing the business. Now that we've decoded the raw numbers, let's extract some professional-level insights. Let's look at the current ratio. You calculate this by simply dividing current assets by current liabilities. For FreshMart, that's 865 lakhs divided by 975 lakhs, which gives us a ratio of 0.89 times. Basically, this means for every 1 rupee of short-term debt, they only have 89 paise of short-term assets. Now, in most industries, a ratio below 1 is a massive warning sign. But because of that brilliant working capital cycle we literally just discussed, where inventory turns incredibly fast and cash comes in daily, having slightly more short-term debt than assets is actually a perfectly acceptable, highly efficient strategy for supermarkets. Now, a single year is just a photograph, right? But comparing 2 years shows you the real story. Let's compare financial year 2024 against 2023 to prove FreshMart's health. Take a look at their long-term loan. It dropped from 1,000 lakhs down to 800 lakhs, so they're actively paying down their debt. At the exact same time, their cash pile grew from 175 lakhs to 210 lakhs. Debt is shrinking, liquidity is growing. This is the hallmark of a very solid, healthy business. All right, let's summarize our journey today. The balance sheet really is that simple once you break it down into these buckets. Assets are simply what you own, your equipment, cash, and inventory. Liabilities are what you owe, your bank loans and supplier payables. And equity is just what's left over, the initial capital and saved profits that belong strictly to the owners. If you followed along this far, you seriously now possess more financial literacy than many seasoned professionals out there. You now have the X-ray vision required to see right into the heart of any business. So what hidden stories could you uncover in the next balance sheet you read? Thank you so much for joining this explainer. If you found this valuable, please subscribe to the ViewPoint for honest, research-backed analysis every single week. I'll see you in the next one.